Bryan, hi, and Stuart MATHIESON from BARINGS. Thanks so much for joining me here at IPEM. You're sponsoring lots of people, exciting stuff. But before we get into all the nitty-gritty, tell me a bit about BARINGS, what's happening, what's changing for you guys. Bryan?
BARINGS is a wholly owned subsidiary of MassMutual. We manage about $450 billion of AUM across public and private credit, real assets, and capital solutions. And we're excited to be here and meet with clients and hear about trends in the market and share our views.
Tell me a little bit about the evolution of your business, because maybe I got this wrong, but I always thought you were a little bit core mid-market player for those kind of solutions. Is that still the case, or is it changing?
The private credit business is still very much focused on the traditional core mid-market. It's grown, of course. So today we have about 53 billion of commitments that really target that core middle market space. We've grown with our sponsor clients and friends over that period of time. But at the core of it is that we're lending to businesses in a certain sector. They tend to be first lien, sponsor-backed, often buy and build leverage buyouts. And we've grown that book over the last decade, and we're continuing to grow it going forward.
There's a little bit of compression, returns compression going on in credit, I think, talking to people around the market. So where do you go in this kind of environment to see opportunities? Is there a geographic difference? How do you look at the market in that environment?
Yeah, I think we take a global approach to the market, so we do have a lens in both North America, developed Europe, and then developed Asia Pac as well. You're correct that spreads are compressing in credit overall, but if you think about the alternative space and private credit, the illiquidity premium is still there. In North America, we're probably looking at 125 to 150 basis points of a premium relative to broadly syndicated markets. In Europe, it's closer to 200 basis points, and similar in developed Asia Pac as well. So, while spreads are compressing for sure, I think the premiums are still there for private credit over public credit.
Yeah, we've seen that. If you look at the public markets today, single B loan is probably trading somewhere between 350 and 375 basis points. So you're not going to be immune to those trends. What I think is important, though, is if you look at the other side of the balance, the risk side, leverage, equity cushions, all of those have been pretty consistent now for the last 5 years. So actually, the type of lending we're doing hasn't changed. We are just going to be beholden to some market trends in terms of pricing.
Let's just get into that compression. What do you think are the core kind of drivers of it? What's happening? Are there just more players in the market? What's going on?
Well, I think if you take a look at where we were and how we got to where we were, over time, over decades, you sort of look at direct lending, it's been in this band of return, absolute return, sort of in the high single digits. And then in 2022, rates blew out and spreads blew out, which we haven't really seen. That was a function of the fact that broadly syndicated markets completely sort of pushed away from the table for a little while. And you've started to see a little bit of a reversion to the mean. Some of that is competition, absolutely, but also I think more of a reversion to the mean than anything else.
Yeah, we've also probably seen now a couple of years where M&A volumes have just been a little bit lower than perhaps people expected. And so when you ally that to the demand side, actually there's the balance, and that's going to drive some spread compression over a period.
Makes a lot of sense. I'm glad you brought up M&A. And a little bit crystal ball time on that. People keep saying it's going to pick up. I think they thought maybe 2025 was going to be the year. We were going to see a lot more sort of equity capital markets activity. We were going to get not quite a boom, but we were going to get some deals done. I think deals are still being done, but maybe not at the pace people had expected. Would you agree with that synopsis? And where do you see us going over the next 12, 18 months?
Volumes pick up. At some point, it will be inevitable. Investors in private equity strategies, they will want capital to be returned. Businesses will mature, and funds will get to the end of their natural life. It has been slower, and I think for the last couple of years, people have predicted there was going to be an increase in it, and it hasn't happened for a variety of reasons. Anecdotally, we've come back post-summer, and teams are really busy. So I think globally, we've got about 120-ish people in our private credit business, which is a really big team for the mid-market. And look, we're having to prioritize what we're looking at, and the quality is good. So there's probably a good reason to think that things are starting to pick up. As a business, though, when we talk about being scaled and having incumbency, that we lend to just under 400 companies already. So when people aren't selling assets, they're typically looking to grow them, and that means often more financing opportunities for people like us. So we're perhaps less geared towards an increase in M&A. I think we'll see one, but actually the business can do very well lending to existing positions as well as new platforms as part of our growth strategy.
And if you think about your comment around spreads and the fact that base rates are starting to come down as well, lower cost of capital obviously is going to free up a little bit of capacity in the M&A side.
Certainly hope so. Investors here, you said it's quite busy. I mean, there's a lot of people wandering around this conference. What are they talking to you about in this environment? What kind of, what are their sort of key questions? Can you guys help with this? This is my problem. What solution do you have for me? Or this is my opportunity. What solution do you have to me? What are the kind of interesting stuff that people are talking to you about?
Yeah, early in the conference, obviously, but I think there's a lot of conversation around issues in portfolios where we might be seeing cracks. Feels a little bit like people are trying to figure out where we are in the credit cycle. Thankfully for us, I think our portfolios are relatively healthy, and we're not seeing as many issues from sort of a fundamental basis, more idiosyncratic, if anything, within the portfolios.
Yeah, as you say, it's early. I've just come back from Seoul and Tokyo, so I've been meeting with a lot of investors recently. One of the trends we're seeing is just how people are looking to diversify their own investment basis. That's not necessarily pivoting away from regions, but looking to strengthen regions and do more in regions they haven't done a lot in previously. So definitely a trend towards more deployment into Europe is one trend we're seeing. And equally, I think people are trending to actually start to look at higher returning capital solutions type strategies. So as a diversifier or as something to put in addition to their core middle market books.
What about sort of structures? Evergreen seems to be coming up a lot, semi-liquid, feeders, this kind of stuff. Is that, you seeing a lot of that as well?
Definitely. 2 years ago, people were talking about evergreen structures, but they really wanted to do closed-end funds. Today, I think it's a real mix. The way Barings think about it is that we have great access to middle market direct lending products, and we have all the different types of structures that people might want to use. So I think we see a real balance between people who are really focused on closed-ended, but a lot more people today are actually open to the more flexible evergreen structures where they can perhaps extend their investment period, top up over time, maybe get deployed a little bit faster. Our job is just to make sure those entry points are there so that we can accommodate what they're looking to do in their portfolios.
Bryan, last word to you. Are you upbeat or a little risk off at the moment?
I'm upbeat. I do believe, from a credit perspective, the markets are relatively constructive. Growth doesn't necessarily need to be at the high end of historical averages for credit to work. You have base rates are still relatively high, spreads are still attractive, and as Stu mentioned, leverage and sort of loan to value is still pretty attractive as well on a historical basis. So it's very constructive for credit, and we're excited to continue to issue.
Good, great. Bryan, Stuart, thanks very much.
Thank you very much.
Thank you.